It's nearly 10 years now since the global financial crisis, a crisis that turned a recession into a depression. It's the job of the Bank of England now to ensure we have a financial system that doesn't do what it did then by making problems in the economy worse. And to do that, we stress test banks against deep recessions and market crashes so we can make sure that they can carry on lending even if the worst happens. You wouldn't buy a car that hadn't been crash tested, and you shouldn't be expected to use a financial system that hasn't been tested either. Because they have to pass these stress tests, Britain's banks are now much, in fact 3 times stronger. You can have confidence that they won't make economic downturns worse. But banks are just half of Britain's financial system. What about the rest? A big part of that is the bond market, where companies borrow to invest by selling bonds to pension funds, insurance companies and asset managers. That market is 2/3 bigger than it was 10 years ago. That's a good thing. It's been the spare tyre that companies have used while the banking system was punctured by the financial crisis. Our job, just as with the banks, is to make sure this source of finance is resilient too. So we have to test it against the unexpected. In this part of the system, the financial companies are very different to banks. In many cases, it's their investors who take the risks. As the small print says, the value of your investment can go down as well as up. So unlike banks, our interest isn't in whether the companies themselves can survive the unexpected. It's in how they act when the unexpected happens. In whether they could act in ways that, although they make sense for them, combine together to cause the bond market to break down. Put simply, the system might be weaker than the sum of its parts. So we're asking, what could happen if asset managers find themselves forced to sell bonds into falling markets? And what if investment banks and insurance companies have to stop buying? What happens in the bond market when there are lots of sellers and not many buyers? How could that affect the wider economy? These are just some of the questions we're looking into. And today we're publishing a paper. It looks at how the combined actions of asset managers, investment banks and hedge funds could cause problems in bond markets. And it concludes that even though they haven't before, problems could arise in some extreme situations. Just as the investment small print says, the past may not be a good guide to the future. I look forward to hearing what people inside and outside finance have to say about it. We're going to be doing a lot more work in this area. And the document we're putting out today is pretty techy, but behind all the technicality is an important and simple point. 10 years ago, nobody was asking, what if there's a problem? What happens in the financial system? We all know how that ended. That's why we've been asking the question of banks, and we are now asking the question of the rest of the financial system too. Thank you.